My name is Nancy Neerman. I am the Assistant Director of the Education Debt Consumer Assistance Program. I'm here with my colleague who is behind the scenes, Carolina Rodriguez, who's actually the director of the program. A couple of housekeeping notes before we start. If you have any questions as we go through this presentation, feel free to type them into the Q&A. Somebody already did ask if there's going to be a recording sent around after this. Yes, if you registered or attended this presentation, you're going to get a recording and a copy of the deck. Carolina is going to be answering your questions behind the scenes. You can ask questions on the topic at hand or anything pertaining to student loans, and we'll periodically break to share those questions and answers with the rest of the group. With no further ado, I think I'm going to um, turn my video off and share my screen, and we will get started. And Carolina, if you can just confirm that you can
Yes,
see the screen.
we can see it. Thank you.
Okay. Today we're going to focus on student loan default, but we're also going to talk a little bit about uh, delinquencies and the things that you can do to come to remedy a default within the federal student loan system. And we're also going to be talking about some of the repayment options that would be available to you once you did get out of default. So before we get into all of that, just a word about our organization and our program. So EDCAP is a program of the Community Service Society, which is a nonprofit that's been active in the New York City area for over 150 years. The program was created in 2019 specifically to address the issue of student debt. So, student debt is the second largest consumer debt in the country after mortgages. There are close to 43 million borrowers that have about $1.7 trillion worth of federal student debt. And the reasons that we created the program, because number one, the size of the issue, and number two, because of the complexity of the system. It's just a really incredibly difficult system to navigate and has become even more difficult over the last few years with all of the changes in administrations and programs that come along with that. So we are a state-funded program, which means we offer all of our services for free, including webinars like these and one-on-one meetings. So after this presentation, if you decide that you need one-on-one counseling, you're more than welcome to contact us and schedule an appointment. And we can help you do anything within the student loan system. We don't only, by the way, deal with federal student loans. We can also help with private debt and institutional debt, which is money owed directly to the school. So let's get right to it. And we're going to be talking today about delinquency, default, and collections. And just a few statistics on the delinquency situation nationally and what we're estimating is the case in New York State. So this is just the federal student loan system. There are close to 43 million borrowers that hold federal student debt. Of that number, and these numbers were reported as of the end of September, about 5.3 million are in default. Most of these borrowers were in default prior to COVID, and that's about a little over 12% of the total. The department is also reporting, though, that close to 3.4 million borrowers are what we would call seriously delinquent. So 271 to 360 days delinquent, which makes you basically in the realm of about to default. So that would put the potential for defaulted borrowers once they report the numbers as of the end of December at about 8.6 million nationally. That's 20% of the federal student loan debt portfolio would be borrowers who are in default. And if the same trends hold in New York State, where there are about 2.4 million borrowers with about $100 billion worth of debt, then there might be about 476,000 or so New Yorkers uh, that are find themselves in default as of the end of last year. So what does it mean to be in delinquent? to be delinquent or have a delinquency, it basically means that you have missed a payment. You've missed just one payment on your federal student loans, um, and that means that you are now behind or delinquent. After 30 days, you're going to be assessed a late fee. After 90 days, those delinquencies are going to get reported to the credit agencies. And at 270 days is when you become at risk of default. And then there's kind of like this no man's land period between 270 and 360 days where you may see a default status on your federal student aid account, but you haven't been moved yet to a debt collector, and you may have some more flexibility in that time frame. But certainly after 360 days, your loans are moved away from the non-default servicers and to a debt collector like Default Resolution Group or one of the guarantee agencies if you have a certain kind of FFELP loans. So what do you do if you are delinquent? There are things that you can do. You can call your student loan servicer and request a retroactive forbearance. That means that they're going to be, let's say you're 2 months behind. They would go back and set the forbearance 2 months earlier, which would bring your account current. Now, this may resolve some of the missed payments that get reported to the credit agencies, but it doesn't always. But it's certainly getting your account current is never necessarily a bad thing to do. But remember, requesting any kinds of forbearances or deferments is just a temporary measure. It provides you temporary relief from payment. It's not a long-term solution. So will still have to basically try to come up with a strategy for paying your loans back. And that means you want to review your existing repayment plans, see if there's a better option out there for you. If you're not in an income-driven repayment plan or IDR plan, and when I say IDR or income-driven, that's an umbrella term for all the individual plans. Then you might want to explore those options because they can generally offer some more affordable payments. Requesting longer-term forbearance and deferment if you have no other options. Again, that's not a long-term solution, however. Now, what happens if your loan is actually in default? So after 270 days of missed payments, or that's basically 9 months, your loans are at risk of default. Certainly after 360 days, they will be fully in default and at a debt collection servicer. And what happens technically when you are in default is that your loans become immediately payable and in full, which of course is a non-starter for most people who are in default. If you could pay the loans off in full, you would do that, and the vast majority of people that are in default cannot do that. But there is ways to actually remedy the defaults, which we'll get to in a minute. If you are in default, you are no longer eligible for an income-driven repayment plan, a deferment, forbearance. You cannot earn credit towards any forgiveness program that you might be pursuing, like PSLF or IDR forgiveness, and then you would have no access to federal aid if you were planning to go back to school. And of course, the biggest thing that you have to be concerned about once you're in default is you would then be subject to involuntary collections. And I see that we maybe there's some actually, I have to update this slide a little bit, but the form that involuntary collections take is that generally the federal government will collect in three ways. They will take your tax refunds. They can offset your Social Security by as much as 15% and leave you with a floor of but they have to leave you with at least $750 a month, which is a paltry amount to live on. And then they can also do an administrative wage garnishment, which would also take up to 15% of your disposable pay. And these are measures that the federal government can take without any court action. They can also intercept funds that you may owe, are owed to you from federal contracts or from the sale of federal assets like a treasury bond. Now, I'm sorry, I apologize. This slide is a little bit out of date, but involuntary collections have just recently been suspended yet again by the current administration. So when you get, we'll fix the slides before we send this out. But basically, at this point, even though they just recently announced that they were going to start administrative wage garnishment, and people were anticipating that they were going to take tax refunds during this tax season, they have announced in earlier this month that they will suspend all of that collection activity to allow for the new rules to be implemented for federal student loans later this year. So they did not give a time frame for when these collections would be switched back on, but they will be switched back on at some point. And we anticipate that this pause will last probably at least until July of this year, possibly longer, but who knows? So for now, just ignore this. There is no immediate threat of involuntary collections, which is good for everybody here who might be in default, because it's going to give you a little bit more time to get your house in order. Now, when we do get closer to the point where collections are about to be switched on, if you're concerned about Social Security offset or a tax refund intercept, you can call this Treasury Offset Program or top line, and it will tell you whether or not you're scheduled for an offset. Okay, now the good thing about federal student debt is that there are actually ways to get yourself out of default. This generally doesn't exist in the private sector, but it does in the federal student loan sector, and there are two ways to do it. There's either consolidation or rehabilitation. So we're going to go through how each of these programs work. So with a loan consolidation, what you're doing is essentially you are replacing an existing defaulted loan with new direct consolidated loans that are in good standing, and then you start making payments on your loans that are in good standing. The way you do that, and the easiest way to do it, is to do it online through studentaid.gov, and you want to submit the direct consolidation application. If you consolidate your loans online to take yourself out of default, you must choose an income-driven repayment plan. One of the IDR plans, which we're going to go into those plans in a little bit more detail later. In many cases, the defaulted loans don't automatically appear on the online application, but you can enter them manually, and you're going to need the following information: loan types, loan dates, balances, interest rates, and the default servicer name and address. Some of this information you can get from your federal student aid account, but if they made it a little bit harder to collect all this data. And if you're struggling with that, you can call your debt collector, which in most cases is going to be Default Resolution Group for all the Department of Education held debt that is in default, and the number is here for you to call them. You'll receive confirmation that the consolidation is being processed, and then once approved and it's fully processed, the defaulted loans are going to be, as I said before, replaced by the new loans. The new loans will be at a non-default servicer. A non-default servicer, for an example, would be somebody like Advantage or Ed Financial, CRI, Mohila, or Nelnet. And during the consolidation process, you have the option of selecting your servicer. So if you were with a servicer that you didn't like previously, you would have the choice to select another servicer. Okay, the pros and cons of consolidation. So the big pro is that it's a relatively easy process to complete by doing once you get past the application, and it can usually be completed relatively quickly within 2 to 3 months. It is also free if it's completed online and it's paired with the IDR plan. You select the IDR plan. The downside to this, if you are pursuing income-driven repayment forgiveness, so this is the kind of forgiveness that you would get by being enrolled in any of the IDR plans and making qualifying payments for anywhere from 20 to 30 years. This forgiveness program does not have an employment requirement. If you're pursuing that forgiveness program and you consolidate your loans, you will lose any credit that you've already accumulated towards IDR forgiveness. For public service loan forgiveness, if you're pursuing that program, you would get weighted average credit upon consolidation. We have a calculator that can help you determine whether or not it makes sense for you to do that, and it frequently does. But the one thing, if you're going to do that, you want to update your qualifying payment count before you submit the consolidation application. That's that PSLF certification form that you can do through the PSLF help tool on your federal student aid account. One of the other downsides for consolidation is that if you have any unpaid interest, it is going to capitalize. It's going to get added to your principal. That may or may not be impactful if you're pursuing certain forgiveness programs. It doesn't make a whole lot of difference. If you're trying to pay the loan off, it might. You must agree to enter an income-driven repayment plan. If you're looking to pay back in a standard or traditional plan after consolidation, you would have to make 3 payments to your collection agency first before you would be allowed to consolidate. There is no credit repair when you consolidate. So the default is still going to appear on your credit report. Unlike rehabilitation, which actually has partial impact on your credit report. But I will point out that defaulted student loans will age off your credit report just like regular consumer debt. Now, it doesn't mean that the debt has gone away and that you don't owe it, but if your default is older than 7 years, the actual default notation is probably not on your credit report. So this is not going to be a consideration when you're trying to determine whether you want to consolidate or rehabilitate. But you want to check your credit report first. And then you cannot consolidate if you have an active wage garnishment. Another important thing to point out, because of the new rules that are going into effect later this year, consolidation may be critical for certain borrowers, and specifically for Parent Plus borrowers who are in default. If you're a Parent Plus borrower and you're in default, your loans are not consolidated, and you're done borrowing, so you don't plan to take out any loans on or after July 1st of 2026, you will need to complete a consolidation before July 1st in order to retain access to income-driven repayment plans and forgiveness programs. If you're a student borrower, and you're done borrowing, you would want to complete the consolidation if you wanted to do that, to just maintain full access to as many repayment plans as you can. So to meet that consolidation, it's a completion deadline. We would recommend submitting the consolidation application no later than April 1st to ensure that the whole process has been completed. Okay, the other option is a process called loan rehabilitation, and here's how that works. With a loan rehabilitation, you must do this through your debt collector. So in most cases, that's going to be Default Resolution Group. They're going to ask you for some income and expense information to set your initial payment. If you don't like the payment that they come up with, you can actually request the income and expense form and fill that in. It's going to document all of your expenses as well as your income. And that in many cases does often result in a lower payment just for the rehabilitation. But keep in mind that post the rehabilitation, the payments that you have to make in an income-driven repayment plan or in a standard plan may be higher than the payment that you agreed upon during the rehabilitation. Once that's all done and you've settled on a payment, you have to review and sign the rehabilitation agreement. And this is very important because if you don't get that rehabilitation agreement signed and back into the debt collection agency, the payments that you're making will not count towards the rehabilitation. And then the process is that you make these payments for 9 months on time and in full over a 10-month period. So they basically give you 1 month of grace period. After you've successfully completed that, your loan is then moved back to a non-default servicer, and the default status is removed from your credit report. Now, when you default on a federal student loan, there are two negative notations that go on your credit report. There's the delinquencies that lead up to the default, and then there is the default itself. With the rehabilitation, the uh, default history will come off of your credit report, but the delinquencies stay until they age off. Once all of this happens, you want to set up the account with a new servicer and choose a repayment plan, and you'll be free to choose whichever plan you want, whether it's a standard plan or an IDR plan. And then you just want to continue making the on-time payments to make sure that you can keep your loans in good standing. So let's talk about the pros and cons of rehabilitation. So pros, it removes the default mark from your credit report, but again, not the late payments. It preserves IDR forgiveness credit that you've already earned. So unlike consolidation, which wipes that credit out if you're pursuing that particular program, rehabilitation you will not lose any accumulated credit that you might have already had on your loans towards this forgiveness program. In most cases, any unpaid interest will not capitalize. If you do have an administrative wage garnishment, this is going to be your only option, and it will stop the wage garnishment after 5 payments. And then after you complete the rehabilitation, you can choose any repayment plan that you want. So for people that might be interested in a standard plan, that's not an issue with rehab. The cons, the downsides to this, it takes 10 to 12 months to finish it. So it's a long time, could take almost a year. It must be done through the debt collector, which can be a very slow and cumbersome process, sometimes unreliable. There's documents that literally go back and forth in the mail. Believe it or not, they still haven't figured out a way for borrowers to upload some of these documents yet. Hopefully that's coming down the pike, but not in the immediate future. Defaulted Parent Plus borrowers who are not planning to take out new loans on or after July 1st of 2026, you're going to lose access to IDR plans if you do not consolidate before July 1st of 2026. So if you're a Direct Parent Plus borrower and you're in default, your loans are not consolidated, and you're looking at choosing between rehab and consolidation, you really want to think about consolidation, because if you don't do that and you choose the rehab route's going to take too long. You'll miss that consolidation deadline. Right now, you can only rehabilitate a loan once successfully, but starting July 1st of 2027, you will get 2 shots. If you rehabilitate a loan and then go back into default, you would have the option of doing a second rehabilitation. And then, as we mentioned earlier, the post-rehab payments in an income-driven repayment plan or a standard plan may be higher than the payment that you negotiated for your rehabilitation process. So one of the key reasons for that, by the way, is that IDR plans only consider your income. They do not consider your expenses. Whereas for the purposes of the rehab program, they will consider both, but that's only a payment for 9 months. This is just a chart. I'm not going to go over all this. This is really for something to you to refer back to. It's just kind of a summary of everything that we just discussed. So why do you want to address your defaulted loans now? Because they've just announced for the second time that they're pausing the collection activity. Number one,
Nancy, sorry, can I interrupt you? Can I chime in to answer some questions that
Sure.
if that's okay
Well,
before
we're
I...
almost to the end of this section. So
Oh, okay, then go ahead.
let
It's
me just finish this, and then we're done with this
sure.
section.
Okay.
Okay. So the reasons why you might want to get out of default now and not wait for them to restart collections is because we know that this pause is temporary. And we don't know when they're going to restart collections, and that could happen with little notice. If you recall, in December, they announced that they were going to restart wage garnishment in January. So it was very little notice until they unwound it again. Getting out of default now is going to help you avoid future wage garnishment, tax refund intercepts, and benefit offsets. And again, once again, just repeating ourselves, I know, but we want to make sure that the message gets through. This is really critical for Parent Plus borrowers If you don't take any action and you're done borrowing, you're going to lose all access to income-driven repayment plans and forgiveness programs if you don't get those loans consolidated before July 1st. Okay, Carolina, go ahead.
Okay, thank you. I we are getting a good number of questions, and I think a good number of folks here may not be in default, which is great. I love it. But I think a lot of people are really worried about the potential of going into default because of an affordability issue. So I wanted just to share that with the group that we hear you, and this is a concern that we have. I am going to try to address some questions. And the big one that is related to that is, what if I cannot afford any repayment plan? And it seems like some folks are contacting their servicer and not getting like real answers or more information that it's gonna help them out understand the landscape, to say the least. So if you're on that boat where you're just concerned that you just won't have any options, I really, really want you to encourage you to one, reach out to us. Let's figure it out. Let's have a conversation because we can take a look at your loan balance, have a conversation about your income, and then see what your options truly are. We do have a calculator on our website. It's a student loan repayment calculator. It's going to show you what income-driven repayment plans look like and the IDR. If you're on the safe forbearance, and I know Nancy's going to talk a little bit more about this, I highly recommend for you to run your IDR application on studentaid.gov and just take a look at what that payment would look like. Chances are you're going to be offered IBR, and some of you may be offered IBR and pay. So take a look at what that looks like. Now, the other thing to consider, because we always go with income-driven repayment plans for obvious reasons, they tend to be cheaper for people who have high loan balances, and you also get credit towards forgiveness like public service loan forgiveness or income-driven repayment forgiveness, which we'll talk about the key forgiveness programs in a little bit. But if the goal is just to keep your loans in the immediate in good standing, you would potentially look at a traditional repayment plan. And that allows you to quote unquote pay it over a long term. You may enroll in a standard repayment plan or a traditional repayment plan if it's cheaper, just to get you to keep them in good standing, but clearly you would need a long-term solution because any traditional plan is not going to have forgiveness attached to it. So I just wanted to throw that out there that we hear you. We are also worried about that cliff of an affordability, especially for people who have been unsafe. Realistically, aside from the payment plans that Nancy's gonna cover, the income driven or the traditional repayment plans, there's really no other way for us to convince the federal government to give you quote unquote a lower payment. The last resort would be, and I don't want to say last resort, the temporary solution if you need just a few months of reprieve is still a forbearance or deferment if you're eligible for a deferment. And those should be short payment pauses. But in general, there's nothing we can do to change the existing repayment plans that they're gonna have available for you. There's no such thing as like, let me show you my income and expenses for purposes of repayment when your loans are in good standing. For purposes of rehabilitating defaulted loans, as Nancy mentioned, there is this thing, income and expenses. But even then, once you exit default, you're going to have to enroll in a repayment plan. The second question was more around parent plus loans, and the person is like, well, my spouse has been working in public service, but the loans are under my name. So that's not going to work. If for PSLF, you would need to be the one engaged in public service and meeting the eligibility requirements, and you cannot just transfer the loans to someone else. Nancy is gonna discuss shortly some other forgiveness programs that we want people to keep in mind. For Parent Plus loan borrowers, I highly, highly encourage you to reach out and schedule a session because there is more things that you should be aware of. And there's additional guidance. We're going to have a webinar next month in February, just focus on Parent Plus loans. Let me quickly answer more questions and then I'll turn it back to you because I know we still have a lot to go to review. What is the difference between NELNet and this one? I am not sure. So NELNet is a student loan servicer and they manage federal student loans. We EDCAP are not a servicer. We are a program of a nonprofit called Community Service Society, and we are state funded to provide direct consumer assistance to people who have higher education debt. Our advice is free, unbiased, but we're not your servicer. We do look at a lot of servicer accounts to be able to figure out how to properly advise clients. I hope that that helps. Um, I am not in default. Uh, okay, I think I already answered. Okay, same thing about Parent Plus loans near retirement. Nancy's gonna talk about TPD, IDRF, but for Parent Plus loan borrowers that like you're healthy, you're not gonna be able to get immediate forgiveness. Usually, and as Nancy will discuss, the strategy is to find the cheapest repayment plan. Again, my takeaway for Parent Plus may very well be is like reach out to us because we want to have an in-depth conversation. Okay, Nancy, I can turn it back on to you.
Okay. I just want to add one more thing to the affordability, or a couple more things to the affordability question. Number one, if you haven't taken a look at it and you're a student borrower, there is a new repayment plan that's going to be introduced um, in July, which may be more affordable than the existing options. Not for everybody, but it will be for some people. It's called the WRAP plan. Number two, if you really are struggling with the affordability question, and after all is said and done, you're looking around, you're looking around and you know this is going to be really, really tough for you, reach out to your local U.S. congressman. At the end of the day, the only folks that can ultimately change this is the Congress. It's not an easy or quick fix, but register your issues and your complaints with your local congressman, um, because they're the ones that down the road can make it better, or can help make it better anyway. Okay, so we want to talk about creating a long-term plan. So when people come to see us, very often they have an immediate issue that they need to address. So they can't afford their repayment plan. They're in default. They want to get out of default. They need help with a forgiveness problem issue. And we'll always, of course, address all of those questions. But we also, when somebody comes to us for a one-on-one, we want to make sure that we leave everybody with an idea of what their long-term strategy is for getting rid of their debt. And within the federal student loan system and the many thousands of people that we've seen over the last 6 years or so, we found that everybody basically falls into one of three buckets. So the first bucket is that your goal is to pay the debt off as quickly as possible. So your strategy is to uh, pay everything, which of course is what most people think of as a strategy for paying debt when they take on debt. But within the federal student loan system, there is an alternative to that, which we're going to talk about in a minute. But the pay debt as quickly as possible is going to apply to people where your income is high in comparison to your debt balance. You have the ability to make payments over and above the required monthly payments, or to make lump sum payments. If this is your strategy, the faster you pay the debt, the less you will pay overall. So it might mean higher monthly payments, but you're going to pay for a shorter period of time, and you save money because you're not paying as much in interest. And we have on our website something called the Student Debt Payoff Calculator. So this is designed for people in this situation where you might want to just find out, like, if I want to pay it off in 5 years, how much is it going to cost me to do that? Or if I can put $500 a month towards the loan, how quickly will I pay that off? So it will help you with that type of strategy. The second bucket, which is where most of our clients fall, is to find a forgiveness program that you are eligible for. It's going to be generally one of two forgiveness programs. The IDR forgiveness, which gives you, which doesn't have an employment requirement and allows you to get your loans forgiven after 20 or 30 years of payments, or public service loan forgiveness, which is a 10-year path to forgiveness. You find a forgiveness program, you make the minimum required payment until such time as your loans are forgiven. So this is going to work for people who have high loan balances, low to moderate incomes, pursuing, again, certain forgiveness programs. And if this is your strategy, there's really no point in making extra payments on your loans, because the whole idea is to pay as little as possible until you meet the forgiveness requirements. And then the third bucket, which is what Carolina was just mentioning a few minutes ago, was make the minimum required payment until death do you part. And while that sounds a little bit depressing, we actually put it there for a reason. And the reason being that unlike most other consumer debt within the United States, the forgiven balances, uh, balances are discharged upon death within the federal student loan system. So that means if you're the primary borrower and you pass away, the debt obligation does not pass to your estate, and so does not pass to your beneficiaries and your loved ones. So if you are an older borrower where you maybe have a bunch of Parent Plus loans, or you took on a late in life loans for yourself, and you're kind of at or in retirement at this point, or close to retirement, and you're not going to be working for 10 years to get public service loan forgiveness, and you may have to pay the loan for 20 or 30 years. That could be means that you have to pay it for the rest of your life. You just want to find the cheapest absolute payment and make those payments, and understand that when you do pass, this is not going to be a burden for your family. Okay. So we're going to talk about the three key forgiveness or discharge programs. There are others within the federal student loan system, but these are pretty much the biggest and the most accessible. So the first one is total and permanent disability discharge. Now, we hope this is not necessarily going to apply to most of the people on this call. However, you should understand that if you ever find yourself in a situation where you have a disability, that it's a mental or physical disability that prevents you from essentially earning a livable wage, you would be eligible for total and permanent disability discharge. And that doesn't mean, by the way, that you can't work at all. It doesn't mean that you're bedridden or in a wheelchair. It just means that there's something that's preventing you from performing the kinds of activities required to hold down like a full-time job that would actually support you. Um, and there's three ways that you can be eligible for this program if you're a disabled veteran, and you meet the certain criteria. If you're on SSDI, SSI, or Social Security retirement, and you meet the requirements under the Social Security program, you would be eligible for TPD. And if neither of those two apply to you, if you can get a medical professional to sign off on a relatively simple form attesting to the fact that you do have these disabilities, you would also be eligible for TPD. Now, the management of this program used to be done by Nelnet, one of the non-default servicers. It has been transitioned to the Department of Education, not without some kinks, and they're still trying to work out the kinks. But you can actually now submit the forms online from your federal student loan account. There's a TPD page that you can get more information, or you can reach out to us if you need help with this. The other big program that I've already been alluding to as we've been speaking is called income-driven repayment forgiveness. Again, forgives balances after making 20 to 30 years of qualifying payments in an income-driven or IDR plan, and that's IBR, Payee, ICR, and the new payment plan WRAP. In addition to that, if you accumulated any credit towards IDRF under the SAVE plan, that will also count once you transition out of the SAVE plan. There's no employment requirement for this program. If you did accumulate credit in Save, Payee, and ICR, these are all plans that are going to be phased out over the course of the next few years. Those credits will be transferred to IBR or to the WRAP plan going forward. So you don't have to worry about losing those credits. But if you do consolidate, and this is a big caution, if you're pursuing IDR forgiveness and you consolidate your loans, it's going to reset that qualifying payment count to zero. So if you're thinking about consolidation and this is the program that you're pursuing, you may want to reach out for some one-on-one guidance before you actually pull the trigger, because once you consolidate, you can't undo it. Now, forgiven balances in income-driven repayment forgiveness may be taxable starting in this year, if they're forgiven this year, depending on your personal circumstances. And then, of course, there's public service loan forgiveness, or PSLF. This program forgives your loans after making 10 years or 120 qualifying months of payments. A qualifying payment is defined as an on-time payment made in full on or after October 1st of 2007. That's when the program started. So anything that you did before then is not going to count towards PSLF. You must have a direct loan. You generally have to be in an IDR plan, one of the IDR plans, or payments in the standard 10-year fixed repayment plan also count. But of course, if you stay in that standard 10-year fixed repayment plan for the life of the loan, you will have eliminated the debt before there's anything to forgive. And then, of course, there's employment requirements. So you must be working an average of at least 30 hours per week for one or more qualifying employers at the same time. And qualifying employers are generally nonprofits or governments. The payments do not have to be consecutive. So you could accumulate 3 years worth of qualifying payments towards PSLF, decide to move to the private sector, and you're in a job that doesn't qualify. If you come back 3 years later, you will not lose those 3 years that you previously accumulated. Now, at the time that you're submitting your last certification form to update your employment, um, you must be employed at that point, when you're at the point where you're applying, you're essentially applying for forgiveness at that point. So you must meet those employment requirements. So if you're thinking about leaving your job, but you're going to be at the 120 qualifying monthly payments, or you're thinking about retirement, make sure you submit that form before you quit or retire. And then you may have all heard, or some of you may have heard of something called the PSLF buyback program. This is a program that was introduced in 2023 by the Biden administration that allows borrowers to purchase months spent in a disqualifying payment status. So that would it would not include things like school deferments, grace periods, or defaults, but it would include periods that you might have spent in the save forbearance. Unfortunately, this program, because I think at the time that they developed it, nobody anticipated the save forbearance, with 8 million borrowers languishing for, a year or more, wanting to buy back these months. It is a labor-intensive program to process the applications, and the current administration has not really allocated many resources to it. So what's happening is the backlog of applications is just piling up to the point now where we think the time it's going to take them to clear the backlog, unless they do dedicate some more resources, is now running at about 3.5 years, which means that this is not a very reliable program. It doesn't mean that you shouldn't submit the request if you're eligible to do it. There's certain criteria that you have to meet. But there's no downside to submitting the request, but you might not want to sit there and wait for them to respond, because you could probably be done making payments on your loans before you actually get a response. So we're recommending for people that maybe are, wanting to buy back all the time in the save forbearance and you haven't switched out yet. We're recommending that you submit the buyback request if you're eligible, but also switch out of save and start making payments in another repayment plan and see which strategy gets you to PSLF first. Forgiven balances in PSLF are not taxable. They will not become taxable this year. I know people get confused because they see a lot of articles about the taxability issue for student loans. That only applies to IDR forgiveness, not to PSLF. And then, of course, you can always continue to verify your employment. This is the only way that you will get an updated qualifying payment count, or if you haven't started yet, this is the way for you to start getting an official qualifying payment count and a tracker on your federal student aid account so you can monitor your progress towards PSLF. So you must file one of these forms, at least one of these forms, for every employer that you've had since October 1st or 2007, or later if your loans were dispersed later. There's no deadline for submitting the forms, but you eventually do have to submit them. So we recommend submitting them annually or whenever you change jobs, because it's just a lot easier to keep up with that if you're doing it annually rather than having to hunt back for maybe an employer that you had 6, 7, 8, 9, 10 years ago. And we very strongly recommend that you use the PSLF help tool from your federal student aid account and request an electronic signature from your employer. So this process has been in place for about a year and a half now, and this is one of the things that actually is working pretty smoothly. If you submit this way, you can get a very, very quick, sometimes within a week, update on your qualifying payment count. If you submit anything with a manual signature, you could be waiting months for them to respond. All right, let's talk a little bit about repayment plans. So we want to talk a little bit about the SAVE plan. For those of you that aren't familiar with this was the plan that was offered by the Biden administration. It was going to be the cheapest option available to most borrowers. It met some legal resistance last year. A court placed an injunction on the Department of Education, preventing them from offering the plan or calculating payments in the plan, which then resulted in the SAVE forbearance, which was placed on people's accounts who were in SAVE starting July of last year. And that SAVE forbearance remains in effect right up until now. Um, the the Department of Education has reached a settlement with the state of Missouri, who is the plaintiff in the SAVE litigation, which will end the SAVE plan sooner than it would have ended under the One Big Beautiful Bill Act. So in the budget bill that's making all these other sweeping student loan changes, they also planned to end the SAVE plan by July 1st of 2028. This settlement, if approved by the courts, will end it before July 1st of 2028. So we're waiting for the courts at this point to approve the proposal. We don't know when that's going to happen. Hopefully sooner rather than later. Once that happens, the Department of Education is going to notify affected borrowers of the timeline for getting out of the SAVE plan. And they've kind of indicated that it's not going to be a generously long timeline. It might be, once they're given the nod, that you'll have a couple of months to make that transition. So if you're still in the SAVE forbearance, you should be thinking about this happening within months. Oh, now we don't know for sure. Things do tend to drag on with the courts and the federal student loan system. But our best guess is that it will happen in the coming months and not, which is basically at odds with what you may be seeing on your servicer accounts, which shows that the forbearance is going to be in place until late 2028. That probably is not going to happen. So you should be thinking about, you don't necessarily have to exit SAVE right now, or the forbearance right now, but you should be thinking about preparing to do this in the next few months. Now, if you choose to stay in the SAVE forbearance, again, which you can, it's not ended yet. Just remember that interest is accruing on your account. That's been accruing since last August, and you're not earning any credit towards forgiveness programs, either IDR forgiveness or PSLF. And if you don't choose a plan in time, once they tell everybody that you have to transition, the department is probably going to place you in a standard repayment plan, which is going to be probably more expensive for most people than being in an IDR plan. If that does happen, however, not to worry, you can still at that time change your plan to an IDR plan. You can, as Caroline, I think she said it earlier, if you're not sure of what your plan options are, you can actually start the IDR application online at Federal Student Aid. If it links to the IRS database, you will get an estimate. You'll see the plans that are available to you, and you'll get an estimate of what you might have to pay in those plans. We also have calculators on our website. Carolina mentioned them before. We have a repayment plan calculator, which shows you all of the existing repayment plans and what you might have to pay in the new WRAP plan. The new WRAP plan is not going to be available on federal student aid yet, and it's not available on their calculators yet. So what are the new repayment plans for the future? This is all part of the new budget bill that is making these very significant changes. So if any borrower takes a new loan or consolidates an existing loan on or after July 1st of 2026, you're going to basically have maximum two options, sometimes only one option in terms of repayment plans. So for a student borrower, you would have access to the new version of the standard fixed repayment plan. That's a payment that's going to be based on the size of the debt, the interest rate, and a payback period, which is going to range from 10 to 25 years, depending on the size of the debt. If you are a Parent Plus borrower, that is the only repayment plan that you will have access to. If you are a student borrower, you will also have access to the repayment assistance plan, the new repayment plan, or the WRAP plan. That is not available right now, but it should be available by July 1st of this year. That plan calculates payments differently than the existing payment plans. It'll calculate your payment based on 1 to 10% of adjusted gross income above $10,000. You will get a $50 deduction for each dependent you claim on your tax return. So this is a less generous treatment of dependents than what you get on the existing IDR plans. There will be a minimum $10 payment. So even if you have no income or very, very low income, under current IDR plans, you might be eligible for a $0 plan. Under this new plan, you will have to at least pay $10. On the plus side, much like the feature in the Save plan, if your payment does not cover the interest, which for many people it doesn't, if you have a large balance and a moderate income, if the payment does not cover the interest, the unpaid interest will not accrue to your account. So it's not going to be, you're not going to see your loan balances continue to mushroom. In fact, as long as you're making whatever the required monthly payment is, if that monthly payment does not pay your principal down by $50, you will get a subsidy of up to $50 per month. So as long as you're making whatever the requirement payment is in the WRAP plan, if it's only $10 a month, you won't see the principal balance going up. In fact, you will see your principal balance going down by $50 per month. If you're married, a spousal income can be excluded when you're for the purposes of calculating the payment when you file separately. So that's a good thing. It gives married borrowers more options to potentially reduce their student loan payments. But there is no protected income and no adjustment for inflation in this repayment plan, as there is in the current repayment plans. And what that means is that going forward, it's just going to be a set percentage of your income, which could be harder to pay as inflation eats into your purchasing power going forward. Nevertheless, it is the only option that is going to be available to these new borrowers or anybody that consolidates an existing loan on or after July 1st of 2026. It does offer a forgiveness in the IDR forgiveness plan, but after 30 years. So the existing IDR plans offer forgiveness after 20 or 25 years. The WRAP plan, you must pay for 30. And it is eligible for PSLF. So if you choose the WRAP plan for PSLF, that's still a 10-year path to forgiveness. And these are just some charts that kind of illustrate what the payments might look like. You can also, again, go to our calculators and plug in more details to get a more sort of pinpoint accurate version of what your payments might look like. The plan on the left is the new standard fixed repayment plan. It's assuming an interest rate of 6.5%. If you have different interest rates, that rate is going to make a difference in the payments. And the WRAP plan schedule on the right assumes that you have no dependents. If you have dependents that you claim on your tax return, you would reduce the payments by $50. Again, minimum $10 payment. Now, here's what's really important to understand about the way the new,
Sorry,
yeah,
Nancy, I'm so sorry. I know that some people are gonna have to get off, and there were some questions that there's one key question that I want to make sure that we get to them before they leave, if you don't mind.
okay.
Um, can you please explain the accumulation of interest? And the main question or concern from borrowers is they're making payments and they feel their interest is growing and that they're not tackling the principal.
So that is, yes, this is the big thing about student loans, right? This is the big issue with student loans is that this is going to happen if you're in an income-driven repayment plan very frequently. So remember, when you're in an income-driven repayment plan, because you're there because your balance is high, but your income is sort of low or moderate in comparison to the balance, you wouldn't be able to afford a payment that would pay down the interest in that plan. So your IDR plans are not enough to cover the interest, and therefore, in the existing plans, any unpaid interest just keeps getting added to your account. Now, this is very disconcerting to see. However, if you're pursuing forgiveness, particularly public service loan forgiveness, the fact that the balance is growing is really not material to you because remember, the payment is not based on the loan balance. The payment's based on your income. So that higher balance is not going to affect your payment. And with public service loan forgiveness, what the higher balances will affect is the amount of debt that's forgiven. Um, but if that forgiven balance is not taxable, that won't affect you either. So for PSLF borrowers, that as bad as it is to watch that the balances increase, it really doesn't affect you. For IDR forgiveness borrowers going forward, it will have some minor effects. Well, some effect on the fact that the amount that is forgiven is larger. So if there's a tax impact, that could be a little bit bigger, although it's generally not going to be, huge amounts more that you would owe as a result of that. Um, and that's really just kind of the way the current plans work. Under the WRAP plan, as long as you're making the required payment, it will not work that way. So I hope that answers that question.
So I think I just want to add because I think there was additional context of someone actually trying to pay off their loans and they're wondering why they cannot see the principal go down. And I just wanted to elevate that with federal loans, for the most part, the interest is set aside and you can see it separately from your principal. There are a lot of borrowers that when they finish school, especially after COVID, where you were not paying, you were not accumulating interest. But in order for your payment to start making its way towards the principal, you do have this potential outstanding pile of interest accumulated that you would need to tackle. And then you do need to calculate what is the monthly payment that you would need to do to tackle the interest on a monthly basis, and then what extra money you want to pay so you can start chipping away at the principal. The other
And
question,
Carolina, can I just
sure.
well, as long as we're on that topic, the on the EDCAP website, the student debt payoff calculator can help you with this because in addition to giving you sort of the like estimated payments, it will tell you or estimate for you what the monthly interest is that's being accrued on the numbers that you plug into the system. So if you plug in the total, including all of your back interest, it will tell you how much you would have to pay to cover the interest.
Yep. And then the other question before some people jump off was for the uh, garnishments, is it 15% of your wages based on gross or net income?
So it's disposable pay, and disposable pay is, let me see if I can get this right. It's your gross income minus any mandated deductions. So it would be your gross income minus federal any money that you put aside for federal taxes, state taxes, local taxes, any kind of mandated retirement, um, and Medicare and Social Security. What does not get included in that calculation is money that you would put into a 401k, or your medical plans, that kind of thing.
Okay, last question because I'm hesitating on the answer in this one. If you took advantage of the Teach Grant, can you use the year's work for both Teach Grant and PSLF?
Well, the Teach Grant, I'm assuming they're talking about the year of service
Hmm.
that I think so. I think so. I don't see why not.
Okay, so
We're
this
not
is different.
100% on that, but I'm pretty sure. So with the Teach Grant, you need to prove that you have done, you need to meet the service requirements. So you're working as a teacher for a certain number of years, and that work as a teacher, though, would also qualify for PSLF. So I don't see any reason why you can't.
Yeah, what you cannot double count is teacher loan forgiveness, the federal teacher
Correct.
loan forgiveness and PSLF. You cannot double count. Usually, we recommend people who have very high loan balances to just pursue PSLF because it doesn't make sense if you get a few $1,000s forgiven, it's not going to get rid of the rest and you cannot double dip. So the short answer is yes. Okay, I'll let you carry on.
Okay, I know we're running a little over, so I'll try to get through this relatively quickly. So I was starting to say that it's important to really understand this new rule under the One Big Beautiful Bill Act. And the rule states that all loans must be paid back in the same repayment plan. And this applies to both student loans and to Parent Plus borrowers. So this is how this works. If you take out a new loan on or after July 1st of 2026, or frankly, if you consolidate any existing loans, if you're a student borrower, then all the loans, including all the older ones, must be paid back either in the RAP plan or the standard repayment fixed plan. You can't split and do some loans in one payment plan and some loans in another plan. If you're a Parent Plus borrower, all your loans, including any older loans that you took out, must be paid back in the standard plan. So even if you consolidate your loans on or after July 1st of 2026, Parent Plus borrowers are not going to have access to the RAP plans. And what this new rule basically does for new Parent Plus borrowers is it eliminates the option of enrolling in an IDR plan, and it eliminates path to IDR forgiveness and public service loan forgiveness. Now, the one exception to this rule is if you have both student loans for yourself and Parent Plus loans that you took out for your children, you can pay the student loans in the RAP plan and the Parent Plus loans in a standard plan. But this is why we keep harping on, like, if you're a Parent Plus borrower and you're done borrowing, get those loans consolidated before July 1st of 2026. For legacy borrowers, so this is if you are done borrowing and you do not take out new loans or consolidate any loans on or after July 1st of 2026. If you're a legacy student borrower, you're going to have access to payee and ICR until those plans are phased out, which is slated for July 1st of 2028. And thereafter, you would have access to the IBR plan or the RAP plan when that becomes available later this year. The IBR, or income-based repayment plan, is going to be the only existing IDR plan that's going to live beyond July 1st of 2028, and that's only for legacy borrowers, won't be available to new borrowers. The IBR plan has no income test, meaning that now anybody with a direct or FFEL loan can get into it. But it does have a payment cap. Payments would be capped at no more than what you would pay in the standard 10-year fixed repayment plan, and the payments are calculated at between 10 and 15% of discretionary income, depending on when your loans were dispersed. So if you have all your loans, or most of, if you've had any loans dispersed before July 1st of 2014, you're only eligible for the older, more expensive version of the plan. If your first loans were dispersed on or after July 1st of 2014, you're eligible for the cheaper version. For legacy Parent Plus borrowers, you must again have fully consolidated loans dispersed before July 1st of 2026. So the consolidation process has to be completed. We recommend submitting the application no later then end March, early April 2026. And then once consolidated, you have to enroll in the ICR plan and make at least one payment, after which you can access the IBR plan. Now, the enrolling in ICR and making that payment, you just have to do that before that plan is phased out in 2028, but we would urge you to do it as soon as possible and then just get into IBR, which, by the way, for Parent Plus borrowers, legacy Parent Plus borrowers, this is probably going to be a good thing. That IBR plan is generally going to be less expensive than ICR, which was the only plan that was available to you under the existing system. Okay, there is just a repayment summary here, a little chart for you to consult. So if you forget who's eligible for what, this is kind of give you the rundown. And then finally, I just want to mention you will have access to this when you get the deck. If you need a one-on-one, this is our contact information. And I will stop there. I don't know, Carolina, are you still there?
I'm still here.
Okay.
I'm multitasking and making sure that my other client is not here yet. There is still a lot of confusion between PSLF and IDRs. Can you talk about the difference?
Yes. So the main difference between the two programs is that public service loan forgiveness has an employment requirement. The program was meant to incentivize people to go into jobs that, require significant credentialing when it comes to, taking on debt, to, expensive degrees, but doesn't always result in significant incomes. So, in an effort to incentivize people to do these jobs like nursing, like teaching, like social work, legal aid, working as a lawyer in a legal aid society, where you're making a lot less than you would in a private law firm. The public service loan forgiveness program was put in place, but it does require that in addition to making the payments in a direct loan in an IDR plan, that you meet the employment requirements, and those are that you work an average of 30 hours per week for a qualifying employer, which is typically a nonprofit or a government employer. The IDR forgiveness program was put in place because somebody said you shouldn't have to pay your student loans back for more than 20 or 25 years, or now 30 years. So if this is going to be the default forgiveness program for people who have very large loan balances, but low to moderate incomes, but you don't have a job that qualifies you for that faster track forgiveness in PSLF, you would go for IDR forgiveness because there's no employment requirement associated with that program.
Thank you. Give me 1 second and let me make sure that I am not missing one that I wanted to flag. Spousal income for purposes of repayment. Can you talk
Ah,
about that?
yeah. So if you're married and you file your taxes jointly, remember, payments in an income-driven repayment plan are always going to be based on your income, whatever that income may be. And generally, it's based on um, a number that comes off your tax returns the last time you filed taxes. If you are married and filing jointly, it's going to base the payment on your combined income. Now, if you both have federal student loans, they make an adjustment for that where it may make sense for you to continue filing jointly. If only one person has, if you're the one, if you're the student loan borrower, um, and but your spouse does not have student debt, the student loan payment is going to be based on your combined income and is going to be substantially higher than what it would be calculated at if you file your taxes separately, in which case they will only take into consideration your income. But I do want to say that the question of determining a tax filing status goes beyond just determining what the difference is in the student loan payments, because it's almost always going to look cheaper to file separately for the purposes of the student loan payment. But you also have to assess what the impact of that filing status is going to be on your actual taxes. So what we generally say to clients that are in this circumstance is come to us. We will help you determine how much more you might have to pay in student loan payments if you're filing your taxes jointly versus separately, but then consult an accountant or a tax professional to determine what the impact is on your taxes. So we've seen situations where somebody, filing separately, you might have to pay $3,000 more in taxes as a couple, but you're saving $10,000 in student loan payments, in which case you may choose to file separately. If the situation is reversed, you may choose to continue to file jointly. So it's a two-pronged decision-making process. Um, Anybody else?
Sorry, Nancy, I was talking with my Microsoft microphone off. Um, okay, give me one second. Just to be clear, for purposes of an income-driven repayment plan, which is the umbrella term, and there are different repayment plans right now that are considered IDR, like IBR, PAYE, ICR. If you file jointly, they will include your spouse's income because they're literally looking at your tax filing, line 11 of your federal return, and using that income. They're doing data match. So if you file jointly, they will include your spouse's income. If you file separately, they should not include your spouse's income. And someone flagged that every year the payment amount increases. That is correct because every year, arguably, that is correct.
If
Because
your income increases.
if your income increases, because an IDR plan means that your payment is based on your income. So every year they're gonna ask you to recertify. Now, because of COVID, a lot of people have not had to recertify and are in fact on a repayment plan based on like COVID or pre-COVID income data. So this is part of the issue that a lot of people are having this harsh reality, unfortunately, that their payment is gonna like triple in part because they haven't had to recertify their income. But the general rule is that every 12 months you would be required to recertify. Your recertification date is usually determined based on when you were enrolled in the plan originally. We will be sharing the recording with everyone after the meeting. You can also usually find our recordings on our website. You will get a copy of the slides. Um, and then let me see here. I think that is it. A couple things that I wanted to point out in the chat. I did include a blog to our married bars for married bars, and I wanted to include one that it is like hot off the press. We just published it, and this is for Parent Plus loan bars. Um, and someone asked, what do the one-on-one sessions look like? So our entire goal is to obviously give you proper advice on your student loans. So our one-on-one sessions mean that we're going to take a look with you together, your student loans. We're going to have a discussion about your repayment plan options and also have a discussion on your strategy. Like, what is your long-term strategy to tackle the debt? So our sessions are pretty comprehensive. And again, you should never have to pay for student loan help. We are state funded, and that allows us to help you always 100% free, and we don't have a cap. So it's not just one meeting. If we need to meet again because you need additional help, we will do that. I did flag in the chat that we are seeing a high demand for services. So if you book an appointment online, you may see that you're booking 2 to 3 weeks out, and that's in part because we have a lot of interest in the one-on-one sessions. I think that's it for my end, Nancy.
Okay, well, I want to thank you all for hanging in. I know it's a lot. It's a lot of information. Um, but you know where we are and you know how to find us. You will get a copy of the deck and the recording. So I hope you have a nice, warm rest of the week, and a warmer, hopefully, weeks coming up. Thank you, everyone.